Hi, I'm Alberto Calva from Acus Consulting. Today, I want to review with you some of the basic financial ratios that we use to analyze the profitability of the company. First of all, what do we have to understand by profitability? When we analyze profitability, what we are trying to check is what is the generation of wealth in a company compared with the resources that are invested in the company. It is a percentage measure. This is not a dollar measure. Therefore, since it is a percentage, we have to compare this number with a parameter or a benchmark. At least the profitability has to be large enough in order to pay for the cost of financing the invested resources in the company. In this case, let's assume that a company is being financed completely by shareholders. Then the profitability of the company should be large enough as to pay for whatever return is expected by your shareholders, at least. The larger, the better. Let's assume there is a company that has financing from debt. This is loans from banks, and also money from the shareholders. In this case, we'll have to do the calculation of the weighted average cost of capital, the WACC. And therefore, we can compare the profitability with that weighted average cost of capital. In another video, we'll talk about the weighted average cost of capital. Now, when we're talking about profitability, there are two ways of analyzing profitability. One is profitability for the company, and the other one is profitability for the shareholder. The profitability for the company, first, we use the probably most traditional and best known financial ratio in regards to profitability. And this is the return on investment, or ROI. And we are dividing operating profit divided by the average total assets. We're talking about operating profit, not gross profit, not net profit. Operating profit, this is sales minus cost of sales minus operating expenses. And then we're talking about the total assets, but we want the average. The problem here is, let's assume that we're analyzing a year. If we take the operating profit from the full year, then what are you going to do? Take the total assets at the end of the year? That could bring us to an error. So we need to, in some way, soften that mistake. And the way to do it is getting the average. At least get the average from the free balance at the end of each quarter. Ideally, get the average from the 12 balances of total assets at the end of each month for the year. Now, more exact than return on investment, I would talk about the return on capital employed. Return on capital employed is NOPAT divided by average capital employed. What is NOPAT? NOPAT is net operating profit after taxes. This means that we take the operating income and then we are going to reduce the adjusted taxes. Adjusted taxes means that you get the operating income and you should reduce the tax that you should be paying, considering that you were paying the same income tax rate that the company has been paying in the last year. And therefore, that way you'll have an idea of what is the operating income after having paid the income tax for that income. Okay, now, what is the capital employed? The capital employed is basically the total assets minus non-interest bearing liabilities and minus cash and equivalents. And the reason here is the non-interest bearing liabilities. Why are we reducing this? Okay, in here is the debt that we have with suppliers. Let's say the accounts payable. When we take 30 days to pay the supplier, we are financing with the supplier. Does that have a cost? Yes, it does. It's not explicit, but it has a cost. When the supplier sends us a material and they know we're going to pay them in 30 days, they will include the cost of financing in the price of the product. So therefore, it is already included in the price. We already have included in the cost of our expenses, and therefore in the operating income, it has been reduced. We do not have to pay anything special for or extra for that non-interest bearing liabilities from this operating income. And then we also reduce from the capital employed the cash and equivalents and the cash equivalents. And basically the reason is because that part has to do with treasury. We can take out of the company the treasury at any moment. And we'll do an analysis of this separately when we are doing the analysis of profitability, but we'll do it in another video. Okay, now let's talk about the shareholder. The shareholder, we're talking about basically the return on equity. And the return on equity is the net profit and divided by the average total equity. So average is basically the same idea. Total equity, this means that we're including the shareholders' equity. This is the contribution that the shareholders did at the beginning when they established the company, plus all retained earnings, plus another concept that could be included in total equity. And we get the average for the same reason we commented before. And then the net profit is the bottom line in the income statement. And that's basically the wealth that is for the shareholder. The shareholder will decide how much of this net profit he or she wants to be paid as a dividend, or how much of this net profit is going to be retained as earnings in the company and will be part of the equity in the next year. Okay. Now, two important things here. Usually in normal times and in the medium and long term, return on equity has to be larger than the return on investment. This is a must. It has to be, okay, in the medium and long term. We'll talk about that in another video. Also, if there is leverage, if there is more debt or less debt, then that will not affect the return on capital employed. Specifically, that will not affect the profitability for the company, but it does affect the profitability for the shareholder. The more debt, the larger the leverage, the larger the return on equity will be for the shareholder. But this can be kept only in the short term. In the medium, long term, there could be some problems. So we have to be aware of that, but we also make a comment about this in another video. I hope that this information about and this analysis of the financial ratios that we use to analyze the profitability of the company has been useful. I am Alberto Calva from Accus Consulting. We are based in Toronto, Canada. Thank you very much.